Selecting mutual funds often feels like standing before a huge buffet. There are so many options, it's overwhelming. Did you know nearly 80% of investors choose mutual funds based on random advice or hearsay, risking their financial health? Today, we'll equip you with a powerful framework to make confident, informed choices while investing in mutual funds. Investors commonly struggle with endless choices, complicated jargon, and the fear of making costly mistakes. Warren Buffett famously said, "Risk comes from not knowing what you're doing." This video is your guide to selecting mutual funds intelligently and independently, ensuring you know exactly what you're doing. 6-step framework for mutual fund selection. Step 1. Define your investment goals clearly. Choosing mutual funds without clear goals is like setting sail without knowing your destination. Are you investing for retirement, your child's education, wealth creation, or short-term savings? Clear goals help you prioritize your investments, ensure better alignment with your life objectives, and increase the chances of achieving these goals efficiently. Step 2. Identify risk appetite. Investing without understanding your risk tolerance is like driving blindfolded. Your risk appetite determines how much volatility you can comfortably handle. Conservative investors prioritize capital preservation. Balanced investors seek a mix of growth and safety, and aggressive investors chase higher returns despite higher risk. Matching your mutual fund selection with your comfort level ensures sustained investing without stress. Step 3. Evaluate fund performance consistency. While past performance doesn't guarantee future results, consistent performance over a period of 5 to 10 years is critical. It's not just about short-term spikes. You need stability and reliability. Consistent funds usually manage volatility better, giving you confidence in their long-term management capabilities. Step 4. Analyze fund manager and team. Every successful voyage needs a skilled captain. Similarly, a capable fund manager significantly impacts mutual fund performance. As they say, there is no future in any job. The future lies in the person who holds the job. In this case, that person happens to be the fund manager. Check the manager's experience, tenure, investment philosophy, and track record. A robust team and stable management provide continuity and adaptability, crucial for long-term investment success. Step 5. Check expense ratio and hidden costs. Investment legend John Bogle said, "Costs matter." Even seemingly minor differences in expense ratios can have a large cumulative impact on your returns over many years. Lower expense ratios mean your investment grows faster, so always scrutinize management fees and hidden charges to optimize your returns. Step 6. Diversification and fund holdings. Remember the wisdom of not putting all your eggs in one basket. Opting for mutual funds with diverse holdings across sectors and asset classes spreads risk effectively. Diversification protects your portfolio from significant declines in any single investment, ensuring balanced growth and stability during market ups and downs. Practical tools and resources. Use reliable websites like Morningstar and Value Research for detailed fund analysis. These platforms provide comprehensive data, performance comparisons, ratings, and reviews. Online investment calculators and simulators can further streamline your decision-making, helping you visualize potential outcomes of your investment choices. Common mistakes to avoid. Avoid chasing short-term high returns, as these are often unsustainable and risky. Don't overlook the importance of fund size and liquidity, which can significantly affect your ability to exit investments smoothly. Frequent switching of mutual funds based on temporary market fluctuations or short-term noise often leads to higher costs and suboptimal returns. Avoid these common traps to maintain steady investment growth. Quick recap. Let's quickly recap the robust methodology. Define clear investment goals, understand your risk appetite, evaluate performance consistency, scrutinize the fund manager's expertise, consider expense ratios and hidden costs, and prioritize diversification in fund holdings. Take charge of your financial future. Subscribe to Money Wisdom today, because true financial freedom begins with informed decisions. Stay wise, invest smart, and secure your financial dreams. And let us know in comments section below which money-related topic you want us to cover in future videos. Till then, goodbye.